Eric Mwadhi with yet another educational video. Let's take a look at how we can use line extensions in trying to figure out how we can get back into a stock after a pullback. So obviously this is the RSI. This is pretty much where I based most of my analysis. So we take the RSI, and if you see a breakout in this particular instant, if you see a breakout, let's say somewhere with the stock moving above this previous RSI highs, more than likely that tends to be a change in sentiment. So if you see the RSI breakout above previous highs, like in this instant there's a breakout here, what you'll notice that the price will start moving higher gradually, and what will happen is at some point there's going to be a pullback. Now, and this is very important, if the pullback comes above this previous entry point, so there was a breakout here, there's an entry point when this price is probably also breaking out, so you have a RSI breakout and the price also breaking out above prior resistance levels. So you have two things going on: price breaking out, RSI breaking out. So if the pullback takes place and if you extend this line down like that, if you ever observe that there's uniform activity below the line and then back above it, that is an entry point. So if you see that happening and the price is starting to move above this entry point here, more than likely there's going to be a bounce, which is going to be very profitable. Now, if you ever observe that by keeping the line extended on your charts, that the stock comes back again, that the stock pulls back, if it happens again that the stock is forming uniform activity below the line and back above it, that also happens to be a nice entry point for a bounce. So this is another entry point. Now in this particular instance, the stock comes again and makes a double bottom, so that's uniform activity because it's going down, up, which is uniform activity around the line and back above it. So once it moves back above the line at that particular instant, that's another buy point. So the price would have dropped a little bit, so you want to buy the stock. So the key here is two things. So if the price is above the perfect price level, then all these rebound possibilities here are going to be successful. So, and then the other thing is, so one, the price should be above the previous entry point, and two, you want uniform activity around or as they go below the line and back above it. So let's take a look at some examples so we can crystallize this idea. So the first example here is SAND, and you can see that there was a breakout when the stock moved above this level here, beginning of 2014, which was this nice entry price here, right there. So there was a nice entry point somewhere there with a gap up, and you can see it also happens to be moving above this declining price channel line. So there was a nice entry point there, price was breaking out. So now note what happens is if we extend this previous RSI highs line, now remember that RSI highs line connects the tops here, that's why we know that once you broke out here, something was going to happen which was going to be profitable. So if we extend that line and keep it in our charts down the road, you can see that when we got this bounce here, seems like a little bit choppy, but ended up being uniformity around there, because pretty much you can even this out as being something like that, U-shaped. Let me remove all that. You can see that this period here is not the best uniformity, but I just want to show you that it also works here. So those movement below that line and back above it, which makes this an entry point, and it's a successful entry point because it's above the ideal entry price. So if it's holding above this entry price here, then maybe what the stock is trying to do is eventually grind its way higher. So notice now that we come back here, we have another uniformity action somewhere here, which is very uniform, looks like a U-type formation here, back above the line. So this here, somewhere around here, was a short entry point, which was not very successful, but you can see again the stock came and formed another uniformity action here, and you can look at this as something that looks like this. Very uniform. So this area here is uniform, this area here uniform area. So this is a nice entry point when it moves back above our line extension. So the movement back above our line extension makes this area here an entry point. And if you use that uniformity method, you can see that you had a chance to make a good return in the stock over a series of about 4 or 5 days. Probably talking about a 15% gain, 20% gain in a couple of days. Let's go on to the next idea or the next example, and we are taking a look at Apple on a weekly chart going back between 2005 and 2014, so about 10 years or something like that. And we are looking at a weekly chart, and if you take a look at this breakout here sometime in 09, which happens to be this entry price here, you see that every time the stock, if we extend this line, you see that this very simple reasoning can keep you in a stock when it's selling off. You can see there was a perfect uniform activity there, which made this an entry point, which was very successful, because since then or after that, the stock would actually continue moving higher. As you can see, had a nice move higher. You come again and touch this line here, uniform activity, hit that line, bounced back above it with uniform activity, which makes that a nice entry point also. Nice entry point for a reversal move higher, which is exactly what happened. You come back again and touch the same line there, which is this entry point somewhere here. Perfect entry point, especially if you are an institution, because you have a chance now to own the stock as it continues grinding higher. Remember, all these entry points are at higher highs, which makes this even more meaningful, because it's holding on to the line while the stock is making higher highs in terms of pullbacks. Now you can see eventually we came very close to the line there, and so that made that also some type of support there, and the stock eventually moved higher. Also notice that here we bounced off this line over many months. We did not breach that line, so this period here, especially for an institution, was a nice area to consolidate the stock. It took a while, maybe about 6 to 9 months in this area here. Eventually you can see that it never broke below that line, and since then, after finding support here with uniform activity bouncing off the line, making the line legit, you can see that eventually the stock gathered enough momentum to move higher. Very simple technique. It's not perfect, but you can see that it actually does make sense, because it keeps you in a stock or tells you when you can make a bet that the odds for a reversal are very high. Let's go to the next idea, and this one here is for Tesla as an example. I want to show you that the breakout took place on the RSI, above the RSI tops lines here, late 2012, price of under, let's call it about $30, somewhere in that range. So that was a breakout there with the RSI breaking out, and so you can see that we touched the line here beginning of 2013, which was that level there, perfect entry point. We formed a double bottom on the line, so you can see that was a very nice double bottom support there, making that a nice entry point here. And since that support level on the RSI, the stock just took off. I hope you can see that double bottom on the line there. It's very evident, as you can see those 2 points there, double support on the line, double uniform activity. Again, we came back and hit that level there, the same line when extended. So the same line that broke out here, extended. You can see there was a perfect support level here, kissed that line, and that was that entry point here, about 120, 125, somewhere there in that range. And since then, you can see how the stock would go on to trade as high as 260. So almost double in price, just because you understand how to use uniformity by extending previous RSI breakout lines. Now let's take a look at one more, and this one is now for the Dow Jones, just to show you that it also works for the general market. This is the Dow Jones weekly chart going between 2011 and 2014. Draw a straight line from the breakout level here, which is entry point here in 2013 there, which is this nice entry point there with a breakout. And you can see that the market has since bounced on the same line. If we extend this line like that, you can see this has been perfect in telling you when to go long the market after a pullback. Nice support there, touched that line, kissed it, and bounced higher, which was that entry point before the stock had a nice short-term move. Notice that there was uniform activity here below the line and back above it, which made that short-term entry point for a nice gain because the stock bounced higher. Touch the line there again, uniform activity, so that made that a nice entry point before the move. And most recently we touched the line there, which was this. So let me draw that again. So we touched the line here, which was this recent lows here. And if you look at my videos, I was telling you that this was going to be an entry point to the upside because I knew that the market was finding support on that line there. So that was an easy call, and since then we can see that the market continued screaming higher. So uniformity works if you know how to extend your breakout levels. It works for individual stocks, it works for general markets, and it works for any trading instrument anywhere in the world. Eric Moade, good luck, peace, and blessings. I am out. Woo!